Have you ever wondered why risk assets are called risk assets? It's because they are susceptible to impairment during economic downturns. Two fundamental investment risks, inflation and recession, should always be front and center for investors. If one could accurately predict recessions, they could sidestep many of the most damaging downturns in risk assets. However, predicting recessions is a tougher task than it seems in retrospect. As an investor, the moment it becomes most valuable to predict a recession is when your correct forecast is at odds with the market consensus for continued growth. The market consensus is far from infallible, but usually it's not unbelievable either. To make a confident move based on your recession forecast, you need to understand why you should trust your projections and why the consensus view of the economy might be more flawed than usual. It's tempting to move your portfolio when you believe the chances of a recession are high. This is a shortcut that many might feel compelled to take. But rather than focusing on a model of how the economy works on average, we should be more interested in the unique factors of each economic cycle. We need to understand the impact these differences may have on the nature of future recessions and the vulnerability of assets when they occur. In building our portfolios, it's crucial to estimate how much of that vulnerability is already priced in. Not all equities look particularly vulnerable to a recession, and many assets are trading at prices that suggest decent medium-term returns even if a downturn occurs. While it's wise to avoid investments that are either overly expensive or don't offer enough return for their higher than normal risks, there are several assets worldwide that offer very appealing expected returns for their risks. The challenge lies not in predicting the average, but in understanding the unique factors of each economic cycle. Opening, how do we determine the vulnerability of our assets during a recession? In the world of investments, the process of assessing asset vulnerability is akin to a strategic game of chess. It's all about understanding the nuances of each piece on the board, or in this case, each asset in the portfolio. This understanding should be reflected in the price of the asset, because the price you're willing to pay should take into account the potential risks and the asset's ability to weather economic storms. Now let's talk about different types of assets. Just like in chess, not all pieces have the same abilities or value. The same applies to assets. Some assets, like growth stocks or highly leveraged companies, can be particularly vulnerable in a recession due to their high risk and expense. Conversely, other assets may display resilience, offering decent medium-term returns even in the face of a downturn. The key is to avoid the temptation to make hasty decisions when you perceive the chances of a recession to be high. Instead, focus on understanding what is unique about each economic cycle, how these unique factors may impact future recessions, and the vulnerability of your assets when they occur. Closing. Remember, not all assets are created equal in the face of a recession. The true test of an investor is not just about predicting recessions, but also about understanding the vulnerability of each asset and making informed decisions accordingly. What drives long-term value changes in a firm? This might sound like a question with a complex answer, but the underlying mechanism is straightforward. It's all about free cash flow. Free cash flow is the cash a company generates after accounting for cash outflows to support operations and maintain its capital assets. It's the lifeblood of any firm, the surplus money that can be used to invest in growth, pay dividends to shareholders, or reduce debt. Now, what makes this cash flow so free? It's free because it's not tied to any specific obligation. It's the money left after all the bills are paid and all the investments are made. It's the money that a company can use to create value. So how does free cash flow contribute to value creation? Well, it's all about growth. Free cash flow growth comes from various sources. Firstly, there's organic development. That's the growth that comes from expanding into new markets or gaining more customers in existing markets. Secondly, there's acquired or M&A growth. This is when a company buys another company to increase its market share or diversify its offerings. Thirdly, there's operational leverage. This is the ability to increase profit margins by managing costs and improving efficiency. And finally, there's the amount of investment or capital used to fund this growth. The more efficiently a company can use its capital, the more free cash flow it can generate. These four components, organic development, M&A growth, operational leverage, and investment capital, all work together to drive free cash flow growth. And this growth, in turn, drives long-term value changes in a firm. But it's not just about growth, it's also about sustainability. A company needs to generate consistent free cash flow over time to keep creating value. It's not enough to have a good year or two. Companies need to show they can keep the cash flowing year after year. So when you're looking at a company as a potential investment, don't just look at the bottom line. Look at the free cash flow. Look at how the company is creating that cash flow and how sustainable it is. Understanding the direction of value creation is crucial for predicting future returns, because in the end, it's the cash that counts. How can we dissect the elements of free cash flow growth? This is where the concept of return on capital comes into play. It's a tool, a lens that allows us to break down the components of free cash flow growth. Imagine return on capital as a spotlight, illuminating the path of an enterprise's cash flow. It's all about understanding where a company's profits come from and how efficiently it uses its capital to generate these profits. Let's take a step back and think about what free cash flow really is. It's the cash a company generates from its operations, money that can be invested back into the business, paid out to shareholders, or used to reduce debt. It's the lifeblood of a company. Now, when we examine the return on capital, we're essentially looking at how well a company is using its capital to create this lifeblood. A higher return on capital indicates a more efficient use of capital, which can lead to stronger free cash flow growth. But it's not just about the here and now. By estimating the incremental changes in return on capital, we can get a sneak peek into the future. These changes can provide clues to future returns on capital and, by extension, future free cash flow growth. It's like having a crystal ball, providing us with insights that can guide our investment decisions. Estimating future returns on capital can provide us with a roadmap to future free cash flow growth. What is one risk that value investors often overlook? You might think it's the market's volatility or the threat of a recession, but it's something far more subtle yet equally impactful. It's the risk of valuation change. Just imagine this. You've done your due diligence, analyzed the financials, and found a stock that appears undervalued. You buy in with the expectation that the market will eventually recognize its true value, and the stock price will rise, leading to a tidy profit. But there's a catch. This entire strategy hinges on one crucial assumption, that the market's valuation of the stock will change. This is where the concept of valuation change risk comes in. It's the risk that the market's valuation of a stock won't change in the way you expect, or worse, it could even change in the opposite direction. If this happens, your expected returns could take a hit, or you could even end up with a loss. Now you might be thinking, but isn't that the whole point of value investing, buying undervalued stocks and waiting for the market to correct its valuation? Yes, that's true, but the key word here is waiting. How long are you willing to wait for the market to recognize the stock's true value? A year? 5 years? Maybe even a decade? This is why assuming multiple increases or discount narrowing to achieve expected returns can be risky. It's not just about whether the market will recognize the stock's true value, but also when it will. The longer it takes, the lower your annualized returns will be. And if the market's valuation of the stock doesn't change or changes in the opposite direction, you could end up with less than you started with. So what's the takeaway here? It's not to avoid value investing altogether. After all, some of the world's most successful investors like Warren Buffett swear by it. Instead, it's about understanding the risks involved and managing them effectively. Because in the world of investment, understanding and managing risk is just as important as predicting returns. So, what have we learned about investment risks? We've delved into the unpredictable nature of inflation and recession, painting a clear picture of why understanding economic cycles is crucial. We've also discussed the importance of assessing asset vulnerability, reminding us that not all assets are equally susceptible to downturns. Our journey took us through the role of free cash flow in value creation, where we emphasized the significance of organic growth, acquired growth, operation leverage, and the capital needed to fuel this growth. We also explored the concept of return on capital, a key metric for predicting free cash flow growth and estimating the long-term value changes of a firm. Lastly, we uncovered the risk of valuation change, a common pitfall for value investors that can significantly impact expected returns. With these concepts in mind, you are better equipped to navigate the unpredictable waters of investment risk. Let's continue to explore, learn, and grow our investment knowledge together.